The third quarter of 2023 caught many economists off guard with surprising growth, but that's not necessarily good news or relief as the Fed continues to fight increasing inflation. GDP soared at an annual rate of 5%, and such a robust economic expansion contradicts expectations. The Federal Reserve needs the economy to slow down in order to tame inflation, and despite this sudden economic surge, Wall Street is weighing in with pessimistic outlooks in the future. Now, economists point to the government's fiscal policy as the reason for GDP growth. The budget deficit doubled in the past year, reaching an astounding $2 trillion, and the sizable deficit, which is more than 7% of our GDP, contributed to the boost in economic growth. About $500 billion of that $1 trillion added to the deficit served as an indirect stimulus, while the majority of the rest of the funds went to bailing out collapsing banks. Another factor boosting GDP was an unanticipated easing of the government's monetary policy, with the Treasury Department halting some debt issuance borrowed from various savings accounts. And this happened because the Fed reduced its bond purchases, and the Treasury responded by issuing fewer bonds. As a result, more money was made available to more people. And now that the effects of this deficit and shift in the monetary policy has been felt, this boost in GDP is unlikely to be repeated, and a return to fiscal tightening is pointing towards a shrinking economy and a recession. This predicted downturn has the attention of several renowned figures on Wall Street. Jamie Dimon, CEO of JP Morgan Chase, warned about the poor track record of central bank predictions, saying, "I want to point out that central banks 18 months ago were dead wrong," referring to transitory inflation and the interest rates expected to rise to only 2.8%. We're currently now double that at 5.25%, and he warned that rates could eclipse 7%. He recommended that investors be prepared for fresh challenges in the new year, saying this may be the most dangerous time the world has seen in decades. Legendary investor Ray Dalio, founder of Bridgewater Associates, is pessimistic about the global economy and identifies geopolitical conflicts and historic government debt as key to stabilizing factors. David Solomon, CEO of Goldman Sachs, who gauges the strength of the economy through mergers and acquisitions, points to a significant reduction in M&A deals, leaving him uncertain about the current economic climate. And Larry Fink, CEO of BlackRock, predicts that interest rates will rise much higher, and that unless the current geopolitical wars are resolved, it will lead to a contraction in our economies. Now, Steve Schwarzman, CEO of Blackstone Group, believes that it will take time to move past the pain of inflation and higher rates. He points out that the recession after 1973 actually followed the Arab-Israel War, and sees that next year may not be so wonderful. He pointed out the fragile commercial real estate market that is now facing 30% vacancy rates, and that is going to have a very bad ending. And with the GDP bump soon to be in the rearview mirror, Wall Street experts are offering pessimistic takes on the financial future. And as the economic landscape undergoes rapid shifts and uncertainties, it's crucial to diversify your portfolio and explore options that can withstand the economic turbulence. If you're concerned about the economy and looking for ways to hedge against the risk, I'm Mackay Block with American Hartford Gold. Give us a call today, and we'll discuss how putting physical precious metals into your retirement account can give you the protection that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.